You have the potential to become a multi-millionaire from an IRA alone. Individual retirement accounts are great vehicles for investing for retirement, mainly due to the tax deduction you receive when you contribute. However, making these common and costly mistakes with your IRA could result in lost money that's impossible to get back. Some of these common mistakes are so simple to avoid, but they can cost you a comfortable retirement after decades of hard work and saving, if not avoided. Watch to the end to see one mistake that is extremely common but so easy to avoid it will have you shaking your head. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Thinking it's the end-all solution. An IRA has its time and place, but it shouldn't be viewed as the best or only option. There are pros and cons to every account type, so you should decide which one will be best for you. This will depend on a variety of factors, such as your current taxable income and your projected income during retirement. For example, those who are offered a 401k match might find that to be the best route despite the disadvantages of such an account. Others might prefer a Roth IRA based on their tax situation and the benefits a Roth account provides, but again, a Roth has its limitations as well. It's not necessary to know every pro and con of each investment account type, especially in the beginning stages of retirement investing. However, this should be something you occasionally review and take a careful look at to make sure your strategy is still best or if it can be optimized. Ignoring the situation and blindly choosing one option could be very costly over the course of your career. Failing to name and add a beneficiary. When people open an IRA, they're usually focused on saving for retirement, not thinking about who's going to get their money when they die. IRA owners often fail to list beneficiaries for their account, potentially creating a huge headache for their heirs. Adding a beneficiary to your account will streamline the process upon your death, and it will ensure the money goes where you wanted it to when you're no longer here. If your IRA has no beneficiary, it's paid to your estate. Once this happens, the account must be entirely distributed within 5 years, meaning it's likely a large amount of your savings will be eaten up by income tax. A beneficiary should be named even if you're young and healthy, because anything can happen. It's easy to do and doesn't take long, so don't overlook this important part of investing. Not understanding RMDs. What you might not know about an individual retirement account is that you're forced to withdraw money whether or not you need it. That's right, even someone earning money in other ways and has no need to withdraw money from an IRA can be forced to, thanks to something called Required Minimum Distributions, or RMDs. RMDs are calculated based on factors such as your age and account balance. Put simply, you must withdraw a certain amount based on how long you're going to live using the average life expectancy. The amount you'll need to withdraw varies based on multiple factors, but it's a significant amount of your portfolio value. If you have $1 million in your IRA and your distribution period is determined to be 10 years, you must withdraw $100,000 per year. In this case, you should have more money set aside in case you end up living longer than 10 years. Don't forget to take an RMD, as the IRS will charge a 50% penalty on the amount that you should have taken. You heard that right. If you fail to take an RMD, the IRS will take half the money you were supposed to get. Not contributing until last minute. Investors have until the tax deadline of April 15th to contribute to their IRA for the previous year. Not surprisingly, many investors wait until the deadline to contribute rather than beginning to invest when they were initially eligible on January 1st. Those last-minute IRA contributions have less time to compound, even if it's only 15 months at a time, and that can add up to a serious amount if done every year. The sooner you're able to invest money, the longer you're invested in the market and the more time your money will have to grow. While the difference is more apparent over long periods of time, the same concept applies to smaller time periods. Not contributing anything to your account until the deadline for the year could mean missing out on a substantial amount of gains. Perhaps the money was sitting in your checking account when it could have been generating returns. Waiting until the last second and investing a lump sum also means you're not using the strategy of dollar cost averaging to its full potential. Thinking of an IRA as an emergency fund. The last thing you want to do is withdraw money from a retirement account before you reach retirement age, especially to buy something that's not needed and unrelated to your retirement. This is a pretty simple concept to grasp, but many people confuse a retirement account with a savings account. If something comes up or they see something they really want to buy, they can just tap the funds, pay the penalty and the taxes like it's no big deal. It is your money and it's available to you if you want to spend it, but blowing retirement money just because you want to buy a new car or pay for home improvements is an irresponsible decision. The money in that account is available to you in a dire emergency, and having it there provides an additional safety net, but it shouldn't be confused as a savings account. To minimize the chances of needing to take money from a retirement account, make sure to have a fully funded emergency account with at least 3 to 6 months of expenses. That way, in the event of a major catastrophe, you can tap your savings account without needing to sacrifice your retirement. Making poor investment choices. An IRA is simply an account where you deposit money, and it's your responsibility to choose an investment inside of that account. Unless you have a solid understanding of retirement investing, this can be easier said than done, but it doesn't have to be difficult. Purchasing a fund that tracks an index such as the S&P 500 is sometimes the best choice you can make. Not only does the S&P 500 return over 10% per year on average, it's diversified across many sectors and industries. If purchasing a fund that tracks an index, try to choose the lowest cost option, as there are many of the same products offered by different companies. All major investment firms offer S&P 500 funds, but their fees or expense ratios vary. Avoid single stocks and other risky assets that have a high probability of resulting in a loss. Choosing an overly speculative or overly conservative investment will end up being very costly, so you want to make the right choice. Letting the funds sit idle. When you open and contribute to an IRA, the money is deposited into an account similar to a bank account, but you must take it a step further. Not everyone knows that you have to make sure those funds are actually invested into something that will grow and not sitting there in cash, losing value to inflation. You wouldn't be happy if you were about to retire after a lifetime of hard work, only to find out the money in the account is practically worthless because the cash sat there idle, having never been invested. With an IRA, you have a huge choice of investment options, like ETFs and individual stocks. You're responsible for doing your due diligence and investing responsibly into something that will match up with your goals. Letting the money sit in your account uninvested will cost you money in the form of interest that you'll never be able to recoup. Say you contribute $12,000 per year for 30 years and invest it, earning an average return of 10%. Your investments would have grown to $2,171,000. If that money hadn't been invested and earned any interest, all you'd have is the $360,000 you contributed. IRAs are a fantastic way to build wealth when you avoid the most common and costly mistakes that countless investors make. Unfortunately for them, it's often too late to correct these errors once they're realized, and in some cases, an entire career of working and saving has been wasted. By being aware of these mistakes, you're able to maximize the account so it will grow and provide incredible returns that can be enjoyed when you retire.